Hi, good evening to all the audience here today and welcome to our webinar, the S&P 500 in India and Why It Matters. I'm Koel Ghosh, Head South Asia S&P Dow Jones Indices, and I'm happy to kickstart this event. Now, these are unprecedented times, and I do hope all of you are safe and at home. I will probably take a moment to thank all those heroes who are working tirelessly to ensure we are safe. Now, in the past few months, we have witnessed changes that will probably make new history. The financial markets are no different, especially if we look at the equity markets, be it India or the US, the story is no different. Hence, investors and portfolio managers have to adopt new strategies to align to this new normal. And one common thing is asset allocation. Now, a diversified approach to an investment strategy is not only the need of the hour, but a good discipline to have. Now, on diversification, an international exposure for local investors is definitely an asset allocation consideration that will be worth, thinking over. Now, today's webinar focuses on this very aspect as we discuss the S&P 500 index. To share some detail about this index and give you an intro, it is recognized worldwide as one of the premier benchmarks for US stock market performance and includes 500 leading US companies across different industries. The index also serves as the basis for multiple index-based strategies and is the only stock market benchmark serving as an economic indicator in the Conference Board Leading Economic Index. And joining us today to discuss this is Hamish Preston, Associate Director, US Equity Indices Product Management, S&P Dow Jones Indices. He is responsible for providing insights and thought leadership on the SPDGI US Equity Index Suite, which of course includes the S&P Dow Jones, S&P 500, I beg your pardon, and the Dow. Along with him, we have Pratik Oswal, who heads up the passive fund Motilal Oswal Asset Management Company. His prior experience includes a fintech startup in San Francisco, and he also has experiences in investment banking, PE, and hedge funds. Before I kickstart this event, I would request you all to take a look at the disclaimer slide, where we do emphasize to the participants that Pratik Oswal is a guest speaker and he's not affiliated with S&P Dow Jones, and that S&P Dow Jones Indices is not providing endorsements as to the opinions expressed, which are those of the guest speakers for this webinar. S&P Dow Jones Indices offers no guarantees or warranties as to the accuracy and reliability of opinions expressed here. And all the guest speakers are not affiliated with the S&P Dow Jones Indices, and of course, except for Hamish, of course, he is affiliated with S&P Dow Jones, but of course, we are not sponsoring, endorsing, selling, or promoting any products which are on these indices. Now, without further ado, I hand over to Hamish to kickstart today's webinar. Hamish, over to you.
Thanks, Koel, and once again, I'd like to reiterate what Koel just said. I hope all of you are safe and well in these unprecedented times. But as Koel mentioned, my slides today are intended to give an introduction to the S&P 500 and to highlight some research that S&P Dow Jones Indices publishes on a semi-annual basis covering the active versus passive debate, and that research has typically shown that active managers have usually underperformed the S&P 500. And then finally, I'll highlight some of the content, all of which is free, that S&P Dow Jones Indices produces that you can elect to receive. And as I said, that will come later. So just in terms of an introduction to the S&P 500 on the next slide, as Koel mentioned, it's widely regarded as the best single gauge of the US market. So just to put that in context, S&P Dow Jones Indices produces an annual survey of assets. And the most recent one from 2018 showed that over 9.2 trillion US dollars was benchmarked or indexed to the S&P 500. So that just gives you a sense of how widely followed and tracked the S&P 500 is. The S&P 500 also has a long history and a broad coverage, with returns data going back to the 1920s, and the index itself, or companies within the index, represent around 85% of the US equity market. Also, within the context of an Indian-based investor, for example, the S&P 500 can offer diversification benefits in that the index offers exposures to sectors that are underrepresented in domestic markets. Before we get into the S&P 500 though, if we just take a step back on the next slide, a question somebody may have is, what's the relative importance of US equities as represented by the S&P 500? Well, here it's key to recognize that the S&P 500 represents around 50% of the global equity market. So on this chart here, we're showing you the market capitalization of S&P 500 companies, as well as various other countries in the S&P Global BMI, which is our global equity benchmark. So quite clearly, you can see the sizable representation of S&P 500 companies according to their market capitalization in comparison to other countries. And you'll see there that India on the far right there is the 10th or so largest country in the S&P Global BMI as of the end of April. That just gives a sense as to why having a view on the US can be important. Now on the next slide, we drill down into various sectors, and it's a similar story. So for example, here we are looking at S&P Global BMI sectors and showing you the weight that is represented by S&P 500 companies at the end of April. So quite clearly across the board, S&P 500 companies accounted for a large proportion of most sectors, and this was particularly prominent in sectors such as information technology, communication services, and healthcare. So once again, this is speaking to the fact that exposure to the S&P 500 may be necessary in order to gain exposure to certain sectors. Now on the next slide, we just drive that point home in an Indian context. So here we're comparing the sector weights at the end of April for the S&P 500, as well as for the S&P BSE 500, which is designed to be a market representation of the Indian equity market. So quite clearly here, you can see that the S&P 500 has greater exposure to sectors such as information technology and communication services, as well as healthcare. So once again, having exposure to the S&P 500 may help to negate any domestic sector biases as they pertain to the Indian market. Now on the next slide, we now go into the long history of the S&P 500. So here we are showing you month-end closing price levels from the early 1928 right the way through to April 2020. So quite clearly, the S&P 500 has a long history. This is useful for historical analysis and putting recent market movements in context, for example. Now, typically, on the next slide, we're showing you the average calendar year price return for the S&P 500 over that long horizon. And on average, the S&P 500 increased 7% per year. But what's important to realize here, and this is really driven home by the chart, is that although 7% is the average, quite clearly there is sizable variation around that average from year to year. And there are some years, such as 2019, when the index rose around 30%, but there are also years where the index fell. Now, in light of the recent market conditions, on the next slide, some of you may have noticed sizable market movements in the S&P 500 between sort of mid-February right the way through to a few weeks ago. And this chart just illustrates that fact by showing the absolute daily S&P 500 price returns. So what this shows is a 1% gain or a 1% decline would both show up as a 1% move in this chart. Now, quite clearly, if we begin at the beginning of 2019 and we go right the way through to May 4th, you can see a tremendous increase in the daily moves. As I said, from mid-February to the end of March. But while it's important to realize, I think, that happened as people were coming to terms with the anticipated impacts of COVID-19. More recently, in April, for example, these moves have begun to settle down, and we have, I think, begun returning to a normal environment as measured by S&P 500 daily moves. And I think in April, that definitely helped the S&P 500 to its best performance since 1987 in terms of monthly performance, as it rose more than 12%. And I think just a bit more commentary on the last few weeks or so. The most recent high for the S&P 500 came on February 19th. Then, of course, COVID-19 came onto the agenda. And really between February 19th and March the 23rd, which was the most recent low closing price level for the S&P 500, the index fell more than 30%. But then towards the end of March, I think we almost entered a bad news is good news environment. And I don't say that lightly, given the clear implications and impact COVID-19 has had on people's personal lives. But within a financial market perspective, expectations for the spreading of COVID-19 and the anticipated economic impact fueled expectations for further monetary and fiscal policy stimulus, which in turn was expected to be positive for financial markets. So that really has helped the S&P 500 gain around 30% over the last 5 weeks or so, between March the 23rd and May the 5th this year. The key takeaway from those moves is that from this chart, some of these moves were negative, certainly, but some of them were also positive. And so volatility can definitely go both ways. Now, on the next slide, we are introducing you to our SPIVA scorecards. Now, the reason I highlight this is that the active versus passive debate is a key debate. It remains so. And S&P Dow Jones Indices publishes information covering the performance of active managers in various regions around the world, from the US to Europe to India, Japan. If you name a region, we have a SPIVA scorecard. So what does SPIVA stand for? Well, SPIVA stands for S&P Indices versus Active. So as the name suggests, they compare the performance of actively managed funds against their S&P index benchmark. And the analysis is done over various time horizons. So what do the results show? Well, on the next slide, we're showing you the latest results from our year-end 2019 SPIVA scorecard. The key takeaway here is that across any horizon we looked at, the majority of active managers in the US focusing on large cap equities underperformed the S&P 500. In other words, beating the S&P 500 has been difficult for many active managers. Just to give a bit more information on that on the next slide, we're showing you the calendar year underperformance figures of large cap US equity managers against the S&P 500. And since 2001, which is the first data points we have from our SPIVA scorecards, what you can see is in 16 out of the 19 years between 2001 and 2019, the majority of large cap US equity active managers underperformed the S&P 500. It's a similar story if you look on a risk-adjusted basis. So one comment somebody may have is that, and this is on the next slide, somebody may have is that just focusing on the return side of the ledger misses the fact that many active managers may operate within a risk budget. So to address those concerns, we publish a risk-adjusted SPIVA scorecard, and the latest version of which comes from year-end 2018. And what this scorecard shows is that the story is largely the same on a risk-adjusted basis. In other words, active managers were not better at managing risk historically, as the majority still underperformed the S&P 500 on a risk-adjusted basis. Now on the next slide, it's also worth mentioning that in certain market environments, people may believe that active managers may be better placed to outperform. And I think in particular, maybe down markets or more volatile markets are those types of conditions. But this chart here really illustrates that across different market environments, active managers found it difficult to outperform the S&P 500. So in particular here, this chart was constructed by first taking the calendar year return for the S&P 500 in each year between 2001 and 2019. And then we identified the 11 years where the S&P 500 rose more than 10%, the 4 years where it rose between 0 and 10%, and the 4 years where it fell. Now what you can see is that across those market environments, the average underperformance by large cap US equity managers was the majority still underperformed the benchmark. So once again, across different market environments, the S&P 500 has been difficult to beat. And that may be relevant in light of the recent conditions that just the historical evidence provides food for thought for those people expecting active managers to have outperformed over the last few weeks. And finally, in my slides, the next slide shows you the available content, all of which is free and is available on our website, that we publish that comments on the markets through the lens of S&P Dow Jones indices. So right at the top there, you have the sign up link, and we have the dashboards cover things from a daily dashboard, which is an email our colleague sends out and provides nuggets of information on market movements. But we also publish monthly regional dashboards and market attributes, which covers the US and India, as well as other regions. We also have other dashboards, as you can see there. And once again, I would recommend those dashboards. They are useful and just for getting a sense of how recent trends have impacted our indices. And so with that, I'll pass it back to Coel.
Thanks, Hamish. That was very, very insightful. And, you know, I do agree, active fund managing versus the passive investing debate is an everlasting one. And even if we see the SPIVA report cards which are in India, we do see some similar trends, especially in the large cap segment where large cap funds are underperforming the underlying benchmark. So we see that trend, I think, not only in more developed regions, but now you're seeing it in emerging markets as well. Now, keeping that thought, and maybe we'll discuss more about active and passive later through Q&A, I now move over to Pratik, who will now give an idea about the S&P 500 and its prospects in India. Of course, Motilal Oswal recently launched the S&P 500 index fund as well. So over to you, Pratik.
Thank you, Koel, and thank you, Hamish, for the lovely presentation. Appreciate you getting up early in the morning. I believe it's 7:30 in the morning there. So thank you for that. And hello, everyone. Good evening, and look forward to having a conversation with all of you about the S&P index and to answer some questions afterwards. So in terms of, I think, my presentation, I would like to slightly, make it relevant for Indian audiences. So why should someone in India look at the S&P 500 index? What does it have to offer to us as investors? So I can focus on that. But before that, I wanted to just spend some time in talking about the industry itself, the background. Why are ETFs, why are index funds becoming a lot more prominent in India, and what has sort of changed in the last 2 years in which I think this market has grown. So on the next slide, so I've talked about some of the growth that you've seen in ETFs and index funds. So the AUM of this category, the passive investing category, used to be close to, I would say, sub 6,000 or 5,000 crores around 5 years ago. And today it's close to 1.5, 1.6 lakh crores. So I think what we've seen is, especially over the last 5 to 7 years, this category has absolutely exploded. Obviously, I think one big reason is because of pension funds and retirement funds, who have pumped in a lot of money towards passive funds. But even if you look at exposure towards retail investors, especially HNI investors, you've seen a huge progress in this category itself. Just to give you a small snippet, the equity mutual fund AUM in India has grown around 2 times to 2.5 times over the last 5 years. But if you look at the passive investing space, that's grown close to 20 to 25 times. So I think that is the opportunity in this segment, and I think and the reason to why this has happened is because, as I said, so a lot of government pension funds, especially the EPFO and other entities, have seen the passive funds as good long-term opportunities. You also had a lot of regulations in place. So for example, 2 years ago, SEBI had recategorized and rationalized the mutual fund schema in India, which made it easier for these active managers to be able to build mutual funds across its categories. Also, what we've seen is that today, when someone is looking at returns of the mutual fund, he or she is not looking at price returns, but also total returns. So what that has done is, I think a lot of passive funds today, if you look at the TRIs, it's actually a lot higher than what people have assumed to be the returns historically. And lastly, I think, as we pointed out in the presentation earlier, I think India as an economy is still maybe not as efficient as the US economy, but I think it is becoming, especially the large cap segment is one segment where, we see a lot of efficiency, and that's where I think the passive funds have done phenomenally well. So that's just the background about the industry, why ETFs and index funds have sort of fared well and why there's huge opportunity. But, coming to international investing, this is something which I think is very niche at this point of time. But, so I have experience managing money for people in the US. And if you look at a lot of developed economies, so there an average investor would have between 20 to 40% allocation towards equity outside his country, which I think is extremely normal. In fact, even if you look at India today, 25 to 30% of our stock market is actually owned by FIIs, which are all foreign institutions. So I think if they see a lot of prospects in investing in India, So I think the idea is that we should also explore opportunities outside of India. So just to see in the next slide, today, all of our funds or all of our money is currently being invested in the Indian markets. And if you look at India today, India is about 3 to 3.5% of global GDP. That's our market share of global GDP. So today, almost all investors, in India are now exposed to this 3% GDP, but we are missing out on the 96, 97%, which is happening outside of India. So most of the wealth creation opportunities that's happening outside of India is currently being missed on. And a fund or an index like the S&P 500, gives you a huge bump in that. You're getting close to, I think if you combine the S&P 500 or any of these international funds, with Indian equities, you're actually getting a really good combination of having one of the world's fastest growing GDPs, which is India, combined with the world's largest GDP, which is the US. So I think overall, your combined exposure is going up dramatically, and I think your portfolio will also show a lot of benefits in terms of asset allocation and diversification. So coming to the next slide, so I think yes, it is. It is important to diversify, or it is good to look at global opportunities. But why the S&P 500 index? So what is special about the S&P 500, and why is this index so significant? Why is the brand equity of this index so strong globally? So just to sort of add to, I think, what Hamish pointed out earlier in the presentation, this is actually a very iconic and historical index. So in fact, as he said, this index roots back to the 1920s, so almost a century old. In fact, the first ever passive or index fund ever launched in the world was the S&P 500 index. And the fund house that launched it was Vanguard, which was a small mutual fund back then. Now it's the world's largest mutual fund. So what we've seen is that, over the last half a century, the S&P 500 has not only survived but also thrived. Now, as pointed out earlier, it's actually the world's largest, I would say, index fund, and it's a default gauge of how the U.S. economy is doing. So I think it's a very, very iconic, very historic index. But what are some of the benefits of adding this index into a customer's portfolio? So I think so in terms of I think now what we're seeing is that today a lot of Indians are sort of stepping away from fund selection and going towards asset allocation. So I think asset allocation is getting a lot of ground in India today, and I think it's important to understand that for you to be able to allocate your assets better, it's important for you to have uncorrelated assets in your portfolio. So what that means is that if you're holding only one asset class, you have a lot of risk associated with that asset class, and a lot of your wealth will go on up and down with that asset class. Whereas, if you have multiple asset classes, if you have equity, if you have debt, you have international equities, you have gold, you have real estate, if you add all that up, you're actually, getting a lot of downside protection, and you're lowering the volatility of your portfolio dramatically. So if you look at the S&P 500 as an index, so if you look at international equities in general, so an average Indian mutual fund today, has a correlation of around 80 to 90%. So it's pretty high. So, I think it's pretty high. And I think what we've seen is, if you've seen the fall of last couple of months, whether an investor held a large cap fund or a mid cap fund or a small cap fund, everything was down 20, 30, 35%. So I think, whereas if you look at the S&P 500, the correlation of the S&P is close to around 15%, which I think is extremely low. And I think it's really adds a lot of value when you put this into your equity portfolio. So I think when most people, talk about diversification, which again is now a hugely talked about subject, they talk about, replacing some of your equity with debt, with gold, with other asset classes. But international equities is one such segment where, you can actually don't have to sacrifice on returns like you have to do with other asset classes. At the same time, you get to actually lower the risk of your portfolio dramatically. So I think that is the opportunity here, and we do feel that, all investors should have, and this is as per global standards, all investors should have a minimum of 10 to 15% allocation towards international equities to make sure that, I think this percolates and gives you that sort of downside protection when one market does well and one doesn't. So I think low correlation is extremely important. And the second, and I would say this is the most important, I would say, reason to why someone would invest in S&P 500 is the dollar. So and this is something you can see on the next slide. So this fund offers you two asset classes. One asset class is some of the world's biggest and most popular brands in the world, so some of the world's best companies. The second asset class is the dollar. And I think holding the dollar today is extremely valuable for most investors. Why is it true? So if you've seen the dollar-rupee equation over the last decade, the rupee has actually lost 5.5% every year on average over the last decade. So today, just to give you my own example, I went to study in the US. If I went to the same college, same school, same degree, I would have to pay around 2.5, maybe 3 times what I paid 10 years ago. When I went, the dollar used to be at 40, 45. Today, it's close to, I would say, 75, 80. So I think it's important to understand that, a lot of our wealth is being eroded, because of the rupee depreciation. And as a house, we feel that the rupee will continue to depreciate at the same level as it has in the past. So I think the dollar is extremely important, and what this fund offers is access to that as an asset class. The other reason to why the dollar is important is because today, if someone is planning for the kids' education, and also I think if you see typically a wallet share today of an Indian customer, we are split between, I would say, 50% Indian products and 50% a lot of global products. So I think our expenditure is happening in dollar, but our income is happening in rupee. So I think having some of your assets, having some of your income being invested in the dollar can really help in make sure that your purchasing power is protected over the long run. So lastly, so one more reason to why I think so the S&P 500 is a great index is because of the competitive landscape in India also changing dramatically. So if you think about it, in the last decade, a lot of these brands that you see on the screen have become household brands. In fact, if I show a lot of investors pictures of the logos of the top 500 companies in the US versus the top 500 companies in India, in the Nifty 500 or the BSE 500, then a lot of people would actually identify more with the S&P companies. These are household brands. These are brands that we use on not a daily, but at least on a continuous basis. And I think having that the stock level diversification, helps a lot for investors. So today, I think almost every mutual fund would have an HDFC Bank in there. But I think it's good to have other companies that are equally, if not better than HDFC Bank, and this fund allows you access to those brands. The other thing that I wanted to cover is also, I think, spending patterns. So I talked about it earlier. Today, if I had to buy a car, back maybe 10 years ago, I only had maybe options between, I would say, a Tata Motors or a Maruti. Today, I also have access to Kia or a Hyundai. So I think our spending patterns are also changing dramatically, and it's good to have stocks in your portfolio that you're also consuming in your daily lives. So another reason to why I think this is the last reason to why I think the S&P is great, and this is a bit of a, I would say, underrated sort of reason, is the high dividend yield. So today in India, because it's a growth economy, dividend yields are actually quite low because it makes more sense for companies in India to reinvest it in their businesses instead of giving it out to their investors. But if you look at mature economies, a lot of investors actually go out there and invest for dividends only. You have stocks like Coca-Cola, who are giving out 4, 5, 6% yields, dividend investors every year. So I think dividend yield is extremely important because you're looking at 2.5% dividend yields that's invested back into your fund every year. So in terms of value creation, in terms of how you can, I think deliver or I would say create wealth in this fund, there's actually 3 different ways. One is appreciation of the underlying index. Second is the rupee depreciation. How much ever depreciates gets added back to your fund. And third is the dividend, which is around 2.5%, and it's been quite stable over the last decade. And just to give you an example, of dividend compounding, If you see this graph, what you can see in this graph is that, and this is completely in USD, so this is not really converted into INR. So if you look at the S&P over the last 30 years, it's grown around 10 times over the last 30 years. But if you add the dividends, it's actually appreciated 20 times. So that is the magic of dividend compounding, and this is why I think a lot of investors end up buying these indexes and holding it for a very long time, because of the dividend, the benefits of dividend. And I think in terms of certain metrics, this what we've seen about this index is also it's actually improved a lot over the last two crises. So today I think we are in the midst of a very unprecedented crisis. But if you compare the S&P to the last two crises, so what we've seen is like a lot of the fundamental metrics of this index have actually gone up a lot, and I think it's a lot more fundamentally, I would say, sound than what it used to be. So just to give an example, back in 2008, you had high leverage, but also high valuations. And if you go back all the way back to the dot-com boom, you had really high valuations, but also I think the earnings were not there. So if you compare that to the situation today, what we're seeing is these companies are actually cash-generating machines. So I think earnings are extremely high. In fact, a lot of these companies, especially some of the top 10 companies, are sitting on huge piles of cash. And second is also valuations, post obviously the fall that has happened because of the COVID crisis are actually quite favorable, slightly, I would say, on average or slightly below average in long-term valuations. So I think that is some of the differences between how we should look at this index in this sort of current scenario. And lastly, just the returns of this index. And this is something which I think we have been covered. But I think it's important to understand that, the returns of this index, especially over the last decade, has been quite phenomenal. So on an INR basis, the S&P has delivered, I would say, close to 4 to 8% more than the Nifty 500, which is a popular, that's basically a pure beta exposure into India. But I do push back on returns. I do believe as an asset manager, we do push back to returns and to tell investors that return should not be the most important, I would say, metric for you to choose investments. In fact, we all know that returns are very volatile and uncertain. So even though returns have been great in the past, I do sort of push investors to look at reasons such as buying the dollar and diversification as much better reasons to why you would have this index in your portfolio as opposed to returns. So so I think just wanted to end with why index funds, and this is obviously a big topic, active versus passive. We just wanted to end on that note, about why should one invest in index fund while wanting diversification outside of India. And just to answer that briefly, that as pointed out, when you look at mature economies such as the US and Europe, I think active fund managers haven't managed to do really well compared to the index funds. So I think the index funds that you have in India, I think are very good alternatives because they make your life very simple. You don't have to go out there and find a specific fund manager. It saves you a lot of fees, and the fees will compound over a very long time. And I think, as you've seen, the returns have also been quite stellar. So I think that's why I think index is what we think is the right way for you to start the process of geographical diversification. So with that, I'd like to open it up for questions. Thank you so much.
Thank you, Pratik, and that was definitely a very compelling argument on the S&P 500. Now, before we start taking up questions, I would just like to remind everyone, because once we start Q&A and then we reach the end, everybody's going to run away. So there is going to be a feedback form at the end, and it is very, very important for us to get your feedback, and we would like to understand how we can keep on delivering such content and something which is of value to you. So please do give us your feedback. Now going back to Q&A, please look at the bottom of your screen, guys. You can post in your questions, and we will try to take as many questions as we can. I assure you that if there are some questions which are unanswered in this webinar, it doesn't mean that it won't be answered at all. We will be getting back to you separately with these answers from the speakers as they are relevant. So, Pratik and Hamish, I think both spoke about the active versus passive, and it is a very, very compelling discussion, which requires, I think, some mulling over, and there have been some questions that I've been receiving from the audience as well. But, Hamish, just to kickstart the Q&A, I would just like to understand, you spoke about the SPIVA US. We in India are aware of the India SPIVA report. What have you seen as, comparing trends across other SPIVA reports?
Sure. That's a great question, so thank you for the people who sent it in. So really there are a couple of main points. First is that shorter-term performance can vary a bit more than longer-term performance. But if you look around the world, that medium to long-term performance is a pretty similar story across various regions. And the key message there is that historically, the majority of active managers, most of the time, have found it difficult to outperform their S&P index benchmark. As I said, that's not all the time, but a key reason for that underperformance typically increasing over longer horizons is that many active managers who were maybe around 5 or 10 years ago, those funds have either merged or liquidated. And so when you consider the opportunity set and you adjust for that survivorship bias, that certainly plays a meaningful role in those longer term performance numbers. The other point I'd highlight is that S&P Dow Jones Indices also publishes research on whether past performance is a reasonable guide for future performance when it comes to active managers. And this is from our Fleeting Alpha scorecard, as well as our persistence scorecard. And what we typically find there is that past performance is typically a pretty unreliable guide to future performance by active managers. And so when you combine the fact that historically, many active managers, in fact the majority, have typically underperformed, along with the fact that identifying in advance those funds that will outperform, if you put those two things together, they represent challenges, I think, to people looking towards active management and trying to identify those people that will outperform.
Thanks, Hamish. Pratik, just your quick views on the active versus passive argument in India. We know it's early days, but what makes you such, active passive propagator? Pratik? Okay, maybe if we wait for Pratik to, maybe he can give his views in the next round. Hamish, maybe we can just move to you. I think some of the viewers had, or the audience had questions regarding whether what you were presenting were USD slides.
Yes. So.
Oh, sorry, USD returns.
Yeah. So I can confirm that the returns that I showed were in US dollar terms.
All right. Okay. So one of the things, and I think this is a very common question, Hamish, and I think it goes back to the essence of indexing. It's like, why would you want to invest in the S&P 500 index, or rather than go into individual stocks? So maybe you can, highlight a bit about, the advantages of index investing, if that's something you can just, briefly share instead of, getting into individual stocks from the S&P 500.
So I think this goes back to the evidence both in academic literature and our SPIVA scorecards, which you can sign up for using the sign up link, as well as visiting spdji.com. And that is that typically active managers have found it difficult to outperform historically. And once again, identifying outperformance in advance has been tricky. And I think in the context of if you take a broad-based diversified index, that can offer diversification benefits. And for those people who do not believe they have skill in identifying stocks or do not believe that other people do, then essentially holding a diversified index may be a consideration for those people.
Okay, thanks, Hamish. Pratik, over to you. So give us an idea about, what is the passive story in India? Your basically, how do you see it? And, how do you think the active versus passive story will pan out for us in India here?
Yeah, thanks, Koel. So sorry, I had some connectivity issues, but basically, I think passive investing in India, I think it's pretty much entrenched that when you look at mature economies such as the US, I think stock picking is become extremely hard. Even though in India, I do think there's opportunity for stock picking, especially in the mid and small cap category. I think you are seeing a fair level of efficiency coming in the large cap space, which is basically where I think a lot of passive investing has made a lot of ground in India. But, in terms of, I think, how I see this playing out, I think I certainly believe that, passive offers a huge level of simplicity, to the customer for him to be able to make the right choices for his investments. So today, if you look at India, there's thousands of mutual funds. If you had to, I think go out there and find a mid-cap mutual fund, it's extremely hard. And what normally happens is that the investor ends up choosing the fund with the best returns. And we all know that, I think, funds that do perform in the past may or may not perform well in the future. So I think what passive does is that, I think it adds an element of simplicity where, I think if you had to go out there and find 100 mutual funds, you could just stick to the index, and I think the index is done phenomenally well, number one. Number two, I think, if you see in India, I think the churn rate of mutual funds is extremely high. So an average person ends up holding a mutual fund for, I would say, less than 3 years, which is very concerning, and I think a main reason to why that churn happens is because of underperformance. So by having a passive fund in the portfolio, I think you can expect that customer to be holding on to this fund for a very long time because he'll never be upset or never be, I would say, disappointed at the returns. So I think that is one element which is extremely important, which is that you will never do badly by holding a passive fund in the portfolio. And thirdly, and this is what is why it's extremely popular, especially amongst the younger folks, is because if you look at someone who's, say, 25, 30, 35, he or she was investing for, say, 25, 30, 40 years. And if you look at that sort of an horizon, it's very hard for you to pick one particular fund manager or one particular strategy. So I think for that sort of, and India is a relatively younger country. So I think that segment, I think we are seeing a lot of investors who are allocating large amounts of their investments or savings into passive funds. So I think that is where we see this opportunity of passive funds. And I do feel that, it's very early days. So today I think you're looking at close to, I would say, 0 to 5% exposure. In fact, I think the biggest issue is more of awareness than anything else. I think most people don't really know what passive funds are, but I do think that over time, people will have a sizable allocation to these funds.
Okay, thanks, Pratik. Hamish, just a question since we are talking about this indexes. So, is S&P 500 just 500 largest U.S. companies?
So that's the short answer is no. Lots of people may think it's the largest 500 companies, but it's not quite that simple. There are several criteria that go into the index, such as an earnings criteria. Companies that are added to the S&P 500 need to have a history of positive earnings. More information on those earnings screens and the methodology can be found at S&P US Equity Indices methodology. But just to give you a sense of the potential impact on that is the same US Equity Index methodology is applied to the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600, which represent the large, mid, and small cap US equity market segments. Now, as you go down the market cap spectrum, filtering out companies that do not have that earnings record has proved beneficial historically, such as the S&P 600 outperforming the Russell 2000 by around 1.7% per year on average over the last 2.5 decades. And we've written a paper on that last year in October. It's called A Tale of Two Benchmarks 10 years later. So once again, that is available on spdgi.com.
Yes, thank you, Hamish. So Pratik, a question for you. I say, you have been spoken and you gave a great presentation on why the S&P 500, but we still have a question from the audience saying that, again, why S&P 500? Why this developed economy and why not some other developed economy? So I know your presentation did elaborate on that, but do you want to just summarize that and share why just, the U.S. markets and S&P 500?
Yeah, sure. So, I think that's a great question, actually. And just to elaborate on, my presentation, something I actually missed out on my presentation is that, if you look at the S&P 500 or if you look at the U.S. economy, or just the index itself, you have close to 40 or maybe a little bit more than 40% of the sales of these underlying companies actually coming from their operations worldwide. So actually, even though this is a very US-based index, even the companies are US headquartered, a lot of these companies, if you look at Netflix, Spotify, Google, Amazon, the US businesses are actually quite steady, but a lot of their exponential growth that's going to come the next 10 years is actually going to come from their operations worldwide. So actually, so we actually, I think, at our AMC called it the world's large cap index because, all these companies are actually quite global, even though they're centered in the US. And I think that is why I think, this is I think anyone who wants to start the process of diversification, the S&P 500 is one such index that gives you, I think, it's good enough for you to at least start the process.
Yeah, thanks, Pratik. Hamish, a quick question for you, basically on the index. How often, do these constituents of this index change?
So once again, going to the methodology, so changes are made on an ongoing as-needed basis, subject to constituents meeting or new constituents meeting those criteria, but also the index committee considers factors such as sector exposures of the index. But clearly, corporate actions and things like that are incorporated into the index, and should there be any bankruptcies, for example, the S&P US equity indices methodology outlines what happens. So there's no set schedule for changes, but as I said, changes are made on an ongoing as-needed basis.
Okay. Great. Now a question for the investment manager, because I think this kind of question is something definitely we can answer. In terms of the investment horizon, so Pratik, a lot of questions, and I think there are bits and pieces of different questions I'm taking from different audience members. Some people asking about, what is the investment horizon that one should look at. One is like, how should I, understand when and how to allocate, what portion should I allocate, should I do an SIP, should I get in a staggered way? So, maybe you can give some, share some idea on that.
Sure. Yeah, no, I mean, those are actually great questions. So in terms of, allocation, so the way we see things is that, this should be a part of your permanent asset allocation, your portfolio. And basically, so whatever benefits I talked about in terms of diversification, in terms of, lowering your volatility of your portfolio, in terms of getting that dollar protection, a lot of these end up percolating to the rest of your portfolio if you have a sizable position in international investing. So, so we feel that every investor should have a minimum of, say, 10 to 15% allocation. But we also believe that, any quick changes in asset allocation is something which may not be good for you in the short run. So I think in terms of, and especially, when markets are very volatile and very uncertain today. So I think what I would, or what we are sort of advising investors is to actually build up this corpus, over the next 6 to 12 months, into that 10 to 15% allocation. So that is basically what we're saying. In terms of horizon, as I said, this should be the S&P 500. I talked about it. It lasted half a century, and I'm pretty sure that it's going to be lasting another half a century or probably more. I think this is something that most people should be looking to invest for a very long time period. So as per regulations in India, most international funds are actually taxed as debt. So ideally, and if you look at debt taxation, if you look at it from a 3-year perspective or a 5-year perspective, you could actually lower your tax outlay dramatically by holding it for minimum 3 years, because that's when your investment qualifies for indexation, which is where your tax outlay goes down to equity taxation. So I think minimum of 3 years is what I would advise everyone. But I think in terms of standard, I do feel that international investing should be minimum of 10 to 15% for you to actually get the benefits of diversification.
Yeah, thanks, Pratik. Well, we can't deny that we are in times that we haven't seen before, markets that we haven't seen before, and COVID is pretty much a big reality here. I am getting a lot of questions in terms of specifics, in terms of how the market will behave and how do we see this. But of course, we can't, I think none of us can here forecast or tell you what can happen in the future. But I think maybe, Hamish, you could just, give us an idea as to how you see that the S&P 500 might be impacted by this COVID-19.
Thanks, Koel. So I think you're right. As an index provider, we do not predict the future. That being said, what we've seen so far this year in terms of the S&P 500 being impacted by COVID-19 was in mid-February, when COVID-19 clearly dominated headlines as it continues to do so. There was an anticipated economic impact, and that, broadly speaking, was negative for the market as a whole. But not all parts of the market were impacted the same way. And an example of this would be information technology companies, while falling, did outperform the S&P 500. And I think that speaks to the fact that many of those companies have stronger balance sheets, and there was an expectation by investors that those stronger balance sheets may help those companies to be better insulated from the economic impact. On the flip side, you had something like energy companies being much more impacted as oil prices fell, for example. Now, as I said, we don't predict the future, but I think what will be an interesting narrative to look at will be just how justified people's fears are over the impact and what those impacts will be. So looking at earnings, I think lots of people will be looking at earnings for clues as to which companies may be more impacted. But it's important to remember that while certain sectors are being earmarked by the market as more impacted, such as sort of tourist-related sectors, I think those sectors have a relatively small weight in the S&P 500. That's not to say they won't have an impact, but once again, when you consider the weight of information technology and communication services and healthcare, I think those companies in those sectors may have a more or have a larger role to play in determining S&P 500 performance. The final thing I will say is that if you look at the revenue exposure of companies in the S&P 500, and this was spoken about in the presentation, they are more global than their smaller cap counterparts. So S&P 500 companies earn a lot of their revenue abroad. And so to the extent that economies around the world begin to open up, and in recent days, in the last week or so, positive news to that effect has boosted markets, and sentiment has improved on the expectation that there are signs that the economies may begin to open. That may also have an impact. So as I said, I think it's not quite as simple as just looking at the US. There's a global picture here, and because of the unprecedented nature of recent moves and the current environment, I do think it's important to consider perhaps a broader set of factors when assessing what may happen, but ultimately we'll have to wait and see.
Great. Thanks, Hamish. And, we would love to continue, but, we have actually run out of time, but not before, I get also Pratik's views on the current, COVID situation. And, given how S&P 500, as an index offers to the markets, given that we also have another consideration, which is our currency factor to be considered, given these aspects, what is your view on the current scenario and, your view on how one needs to look at investment and investment strategy in these COVID times?
Yeah, thanks, Koel. So in terms of current times, as Hamish pointed out, I think not only should I predict, but also I can't predict the future. So I think it's very hard to say as to how this situation will play out. But I do think the current stimulus that the government is, it is what we've seen from history, is that even in 2008 crisis, the stimulus spend was actually directly related to why the pullback was a lot better than countries in emerging markets. So I think that is the opportunity, and that is why the markets have reacted relatively better for US indexes versus some of the Indian indexes. So I think that is an important aspect. In fact, just to reiterate from the weekend, I spent the weekend watching Warren Buffett's annual meet, and I think even Warren Buffett I think it's very hard for him to say what the situation will look like, but I think he said two really important things. One is that to never bet against America, which I think it's been proven time and time again. He's seen, I think, almost everything, I think over the last 80, 90 years, including a couple of world wars. And, the investors have not only survived, but also, built tremendous amount of wealth over the last 20, 30, 40 years. And he also talked about the credibility of the S&P 500 index as an investment. So I think, yes, the situation is quite, it's very hard for you to say, but as an investor, we are advising investors to sort of stagger their payments to make sure that at least, you're not sort of falling into the greed and fear bucket. You're continuously investing and building a portfolio from currently, I think, close to maybe 0% to, I think, 10 to 15% is where, I think you'll see a lot of benefits of this diversification.
Thanks, Pratik and Hamish. And, just to summarize, it has been a very, very insightful, time, and the presentations were very informative. I think both Hamish, who gave an in-depth understanding of what the index is, and Pratik, who brought, the relevance of that index to these markets. I would really like to apologize to a lot of the audience here because we are flooded with your questions, and I tried to, basically try and put few questions together and try and answer as many as I could. But like I said before, we will be answering individually to each and every one of yours, based on what that question is and whom it is relevant for. And, just to close it out on the active and passive, because there have been a lot of questions, on its relevance, whether it's going to, it is going to be relevant for the market today. There are some fund managers who are saying, it's no longer a relevant, kind of investment pattern given this market. But I think there are going to be skeptics at all point of time. I think passive and active, the way we speak about it, can also form a part of your core and satellite strategy. You either keep active and as your core if you're such a big active propagator, and keep passive on the satellite radar, or keep passive at the core. I would definitely, because I'm a strong believer. On that note, again, please requesting everybody, please do fill the feedback forms. Thank you, Hamish. Thank you, Pratik, again, and thank you, everyone. Have a lovely evening, and please stay safe, stay home, and take care. Bye.